Welcome back everyone to the Money Control live stream. You're watching Markets with Santo and CJ, and it looks like the last street is a little tentative going into that crucial US Federal Reserve monetary policy statement later in the day. If you look at the Nifty and Sensex, although they have come off a bit from the day's low, they're still looking set to close the day in the red zone. Also, if you look at on the FNO side, there has been a little bit of addition of short positions ahead of that crucial meeting. So clearly, some investors or traders are betting that tomorrow might be a very volatile day for the market. Overall, if you look at the international markets, there the headlines have been dominated with what is happening in Russia and Ukraine. Crude oil prices surged over 2% Santo after Russia's President Vladimir Putin said that they are partially mobilizing their forces once again. So clearly, some ripples being felt of that announcement, not only in the commodity market, but also in the forex market, with the euro US dollar peg also suffering at this point of time. So, Santo, the main event is up next, and it has been an event that everybody almost thought that was a non-event almost, but suddenly everybody has woken up and realized that there's something to watch out for here.
But I'm just wondering here, CJ, what new is the Fed chair going to tell the markets here? In the sense that at the Jackson Hole summit, clearly symposium, he had set the tone and made it very, very evident. And you saw the market reacting to that, but immediately shrugging off concerns. So this is like a buy on dip market. Occasionally, you will come across the posturing by the central banks, the Fed notably, and then after that, sometime later, things again seem to be returning back to normal. Again, the market is frantically trying to look for the silver linings in every dark cloud at this point. And when you look at India again, there's a clear reason why we are seeing the market move up so much. Clearly, the macro situation appears to be much better. But that said, valuation again is a bit of a concern. So how much higher can the market climb from here is the big question. But that said, I think CJ, you're unlikely to see probably that's my take, any sharp downturn, even if the global markets were to react on Wednesday.
I think, Santo, if you look at today's market action, clearly there has been a little bit of defensive posturing in the market. With, if you look at some of this, if you look at the sectoral index on NSE, the Nifty FMCG is the only index in the green at this point of time, higher by about 1.5%, which is a good, a good sort of up move on that index. So clearly showing that investors are hedging themselves a little bit ahead of the meeting yesterday later today, because clearly, given the market's confidence that there is not much surprise left in the bag from the Fed, if in case there is a surprise to come, they don't want to be caught on the wrong side, Santo.
Well, yeah, at this point, 82% of the respondents surveyed by CNBC poll that it showed that they are expecting a 75 basis point hike, and just about 18% are
expecting a
100 basis point hike. So, and there are merits and demerits of both things. If you put a 100 basis point, this is clearly giving a signal to the markets for once and all, but then there will be collateral damage to the economy as well. So it remains to be seen if the Fed would take such an extreme step. Well, that said, let's quickly take a look at the stocks on our watch list this afternoon, beginning with SBI. CJ, clearly an outperformer in the banking space. SBI and ICICI Bank have been the two stocks which investors have been really chasing all throughout the last couple of months, and again for good reason. With credit growth now picking up, the largest bank, which is SBI and ICICI Bank, they are clearly in the best position to benefit from it. And that said, asset quality was the biggest problem with the public sector banks in general, and not just SBI but across the board. And most of the banks, the leading banks, at least the leading PSU banks, have done to rectify that, including SBI, and that is where the sentiment for the stock has been changing quite a bit. And besides, and while SBI has said that it has no plans to delist YONO at this point in time, you can't really ignore the valuations and the huge customer base that it brings to the table. So, and lastly, there is the question of valuations. Valuations at less than 2 times trailing book is again reasonable, I would say, for a bank which is growing at least industry rates after having lagged it for quite some time.
Well, Santo, if you look at it from a historical perspective, I think clearly valuations are probably right about at the mean level or a little above mean. So I don't know whether there is enough upside left in SBI going ahead, because let's not forget that the PSU tag itself, attracts a certain sort of a discount from the market, given that You never know what may happen. The asset quality in itself will always be, priced at a discount compared to a private sector bank. So I think therefore, for me, there seems to be a little upside left as far as valuation is concerned. But my only concern with respect to growth is that SBI's guidance for credit growth in FY23 has been somewhere in the line of 10 to 12%, if I'm not wrong, compared to almost more than 15% to 18% to the private sector rivals of its own size. So clearly, I think there is some bit of lagging behind as far as performance is concerned. Maybe SBI will outperform, you never know. But at this point of time, I just feel that given that, difference in loan growth, probably just justified that the SBI has been valued at less than what ICICI Bank or HDFC Bank is being valued at.
But that's always been the case, CJ.
Yes,
it's not that you're seeing
and
it all of a sudden.
Therefore, my argument that probably I don't think that upside at this point of time, at least until unless there is, some even more meaningful credit uptake in the economy, wherein we go beyond the 20% mark, which we used to see in the heydays of 2003, 2008. Until unless that happens, I really don't feel that there is need for more re-rating as far as SBI is concerned. Apart from that, if you look at all the technical, indicators as well, some of the momentum indicators at this point of time are just about in the overbought level. Yes, they can stay in at that level for extended periods of time, but clearly there is an indication that a pullback is merited in the near term, and it will be interesting to see whether we see a meaningful pullback in the stock that could probably, provide opportunities for some of the long-term investors to get into the counter once more. Well, the next stock on my radar today, and is the headline of the show today, is Endurance Technologies. Now, the problem with Endurance Technologies is that it's very heavily reliant on Bajaj Auto, Santo. Bajaj Auto brings in almost 45% of the business, and on the show previously, I have talked about the problems or challenges that Bajaj Auto is facing, in particular with the export market. If you look at the past 3 to 4 months, sales volume data, clearly there has now been a substantial decline in exports of three-wheelers and two-wheelers by Bajaj Auto, and that is something that is going to weigh on the profitability and earnings of the company going ahead. Now, with that, with volume decline for Bajaj Auto, clearly it would not require as much supplies or auto components as it required earlier, and that should also lead to volume decline and revenue decline for Endurance Tech going ahead. Apart from that, Kotak Equities has come out with a note yesterday, and they have downgraded a stock to a sell rating at this point of time, and cut their EPS estimate for the stock for FY23, for the company for FY23 by 4 to 5% at this juncture. So clearly, I think the tide has turned a little negative for Endurance Technologies, largely because of its dependence on Bajaj Auto.
Well, no disputing that, CJ. And if you look at the margin profile itself, over the last 3 years, there's been severe margin pressure there. Things from around 16%, the margins have now come down to close to about 11%. So that is something that the market is worried about. You've seen a good bounce in the stock, though.
Yeah, I think it rode the initial rally in auto ancillaries. But since then, I think there's
I think the overall outlook for the auto sector in general, now that prices have run up fair bit, and of course, you've got the festive season coming up, and that is where most of the auto companies in general have pinned a lot of hopes. They've said, at least they've sounded quite
well, they have filled up those inventories clearly, so they are really hoping.
And now they are waiting for the buyers to show up at this point in time. But after the run up, some bit of profit taking is but natural, and I think that is what we are seeing it. And if you don't have strong numbers to back up, then I think you're in more trouble, which really seems to be the case with Endurance.
Yeah, November would be a very crucial month, because that is when the October sales data will come out, and only then we will get a true picture whether market's hope on demand was actually worth betting on. That's it, Santo. Which is the next stock on your radar?
Well, Sun TV is the next stock. Stock had fallen quite sharply sometime in June. It had fallen all the way to about 400 levels, and since there it's managed to stage a smart rally. It has climbed all the way up to a little over 510 odds. But that said, probably the rally may have run its course for the time being when you look at the overall picture. The June quarter numbers were slightly better than expected, but does not seem to have been sufficient enough trigger for investors to change their mind and kind of re-rate the stock. One of the weak links in Sun TV's armor at this point in time is the fact that it's not been investing heavily in its OTT business. It's been dragging its feet. In fact, it's been trying to put more heft into its movie business, and the returns there have been pretty mixed. It's also fighting to hold on to market share in some of its key markets. And if you look at the subscription revenues, that won't change till the new tariff order is notified. So that is another negative. Besides that, you of course have the corporate governance issues which you had seen earlier this year when the top brass had managed to increase their compensation despite protests from foreign institutional investors. So all these things probably I think could hold back a meaningful recovery in the stock. You've seen a good bounce from the lows, but that said, the rally has been done, and probably here on you could see the stock either be just a market performer or even underperform the market.
Santo, your points are fair, but I think what the market is reading at this point of time is the possible revival in advertisement sales. This is an argument that has also been made in favor of Zee Entertainment as well, because we are expecting advertisement and promotion expenses from FMCG companies in particular to go up in the second half because of possible leeway they might get on the raw material side. So clearly there is expectation that for media companies like Sun TV or Zee Entertainment, advertisement sales will bump up in the second half of FY23, and I think that is where a lot of the expectations on earnings front are at this point of time. Apart from that, I don't think that the focus on movie production, Santo, is a bad bet. I think it is a very strategic bet that the company is taking at this point of time, because they have realized that there is very, very strong pan-India demand, not only just a southern region specific demand, but a pan-India demand for southern-based movies. And clearly they are the ones among the big producers of southern movies out there in the country, and I think they are betting big on that. And it is possible that yes, earnings from movie business can always be volatile, but it is something that it is worth betting for given the demand out there for those sort of movies. Apart from that, the other way around to look at it is that they also largely own the rights to stream those movies on OTT platforms. So when those movies after the theaters come back onto their streaming platform, they can again monetize those assets. So clearly, I think movie business, getting into the movie production business may not be as bad a bet as a lot of the market is fearing at this point of time. Well, the next stock on my radar today is Ethos, and this is one stock that has cropped up on my radar because of a report, coming out from MK Global today, and they have initiated coverage on the stock with a buy rating because they believe that the luxury watch market in India is set for a new, new cycle as such. This is largely a play on the rising, per capita income in the country. Of course, if you look at examples of, places like China and Brazil, there when the per capita income did start to increase, luxury watch volumes grew by more than 13 to 14%. At this point of time, MK has gone very conservative and only baked in 9 to 10% volume growth going ahead over the next 3 to 4 years. And even then, they're expecting almost 13 to 15% revenue growth in the coming years for the luxury watch market. Now, Ethos, Santo, has very less competition in this segment, and therefore there is a belief that they can double their market share from about 15% in micro markets to about 30% going ahead. And I think that is the play that MK is looking at. Overall, the brokerage firm is expecting almost a 42% upside in the stock in just the next 12 months. So the longer term view, of course, is for much more, but at least for the next 12 months, they're looking at a 42% upside on the stock.
Well, my long-term take on this company is largely based on the watch-wearing trends of millennials, right? Okay. Most of them seem to have a utilitarian approach here. If you look at it, mostly the digital watches which are in rage right now.
But sometimes, this generation, the Gen Z, is actually trying to bring back a lot of the old trends. I mean, you look at, flappy jeans, you look at jeans jackets and all that. Though all those trends of the early 2000s and the 90s, it seems to be on the revival. So you never know. Maybe they will have a taste for luxury watches. Who knows?
Well, one never knows. But as a theme, this does make sense. As affluence rising, affluence clearly spells good for certain consumer discretionary items. Liquor is one of them, and the other one is luxury products.
Premiumization has been a theme across the board, across the consumer-facing sectors in India, and probably Ethos is one other play on that.
Yeah, but that said, right now, I think what is driving the rally in the stock is also to do with the fact that it's got very low floating stock, just about 1.9 crore shares overall, and 65% of it is with the promoter. So you have just 35% of that, which means what? Barely about less than 70 lakh shares in circulation at this point in time. And there is chatter that some HNIs have kind of accumulated the stock and are now putting the stock in play, as they call it. That's one of the factors driving the stock.
Possibly. But at this point of time, at least fundamentally, the story looks quite good.
I'll grudgingly give it to you, CJ.
Thank you. Thank you.
The last stock on our watch list is Triveni Turbine. The stock was in the limelight today because of the
mega block
deal whereby its parent has reduced stake in the company, and this has been picked up by a clutch of institutional investors. That's we still have to get the exact identity, but clearly that block got absorbed quite easily. And now if you look at Triveni, it's clearly one of the market leaders in the steam turbine segment. So far it's been a dominant player in the 30 megawatt steam turbine segment, and now the company is trying to foray into the 30 to 100 segment, or 30 to 100 megawatt segment also. Besides that, it's getting into the API segment, which is the general purpose turbine, which is largely used by the oil and gas sector. And according to brokerages tracking the company, this is one of the reasons why probably the company will be able to sustain its premium valuations. Order book is pretty strong at this point in time, close to 10,700 crore of order book, so that provides visibility there as well. Besides, the company has been able to maintain its margins pretty well over the last few quarters, so things looking pretty good for Triveni Turbines at this point in time.
Yeah, I mean, Santo, if almost 21, if I'm not wrong, more than 20% of equity changes hand and the stock is higher on the day, that clearly goes to show the investors are quite happy with the sort of marquee investors who likely have picked up the stake. From what we are hearing, there is a clutch of sovereign wealth funds also involved in the block deal. So clearly, there was very strong demand from institutional investors because they are looking at the stock as a play on this market, and they are quite confident that the earnings growth trajectory on this stock will continue to go upwards, and therefore you can see the demand on the counter today with the stock higher by about 1% at this point of time. At one point of the day, it was higher by almost 2.5–3%. So clearly, it's given off some of those gains, but still looking set to end the day on a green note, Santo.
Well, and a quick look at the market at this point in time. The selling pressure has intensified. The Nifty is down by close to about 100 points, and the Sensex is down by close to about 264 points. So late afternoon selling.
Yeah, Santo, and if you look at some of the top losers on the Nifty at this point of time, as Shree Cement, Adani Ports, IndusInd Bank, Hindalco, and Ultratech Cement. Cement stock clearly seeing a little bit of profit booking, I think, after the rally that we have seen in these counters over the past 2 to 3 sessions. Clearly some bit of profit booking creeping in. And among the top gainers at this point of time, Santo, is clearly the three giants from the FMCG space, Britannia, HUL and ITC, leading the pack, clearly higher by about 1.5–3% at this juncture. And I think all of this is the caution that you can see in the market ahead of the crucial meeting of the US Federal Reserve.
Well, so a lot of central bank action over the next couple of days. Tell us all
definitely
about it, CJ.
I mean, Santo, you have the Fed, of course, we have been speaking about it throughout the show, and as you mentioned, of course, 75 basis point is the expectation. I think what will be more crucial for the market is what the Fed has to say about the rate trajectory going ahead. The expectation is that terminal rate, that rate at which the Fed believes that it is neither harming the economy nor it's aiding it. I think that is expected to rise from about 3.5 to 3.75% to about 4 to 4.25%. We'll have to see how the market reacts to that, and also if there is another indication that the Fed would want to raise interest rates again by 75 basis points, because so far the market is only baking in a 50 basis point rate hike in the next meeting. But if that inches higher to 75, I think that is something that that could take the market by surprise. Apart from that, tomorrow you will have the European Central Bank as well as the Bank of England coming out with their monetary policy statement. So ECB is expected to also raise interest rates. The Bank of England is also expected to raise interest rates. So clearly a lot of central bank action over the next 2 days, and it will be very interesting to see how the bulls react to that.
Well, CJ, here's what makes the market so interesting. Typically, rising rates are always bad for equities. That's been the trend for a long time. But here you're seeing exactly a different kind of situation where rates are rising, but so are equity prices.
Exactly, and I think, Santo, probably the only supporting argument here is that the earnings growth trajectory has been strong. Until unless investors see tangible signs that earnings themselves are suffering, as they were fearful of in the June quarter, and you did not see that much of a cut in earnings estimate after the June quarter earnings, as the market had anticipated when we had fallen almost to 52-week lows back in mid-June. So clearly, the resilience in earnings is what is keeping a lot of investors happy at this point of time. And if that foundation gives way, then of course you could expect a capitulation.
Or the willingness to pay more for the lower earnings. That's also another
Possibly,
way of
that is
looking
also
at it.
true. I mean, there is always, markets are always driven also on hope, apart from sentiment as well as earnings.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching as always, and please post your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of the screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the MoneyControl app. We'll catch you again live tomorrow morning at 9 o'clock with all the action. Till then, have a great day.